Hello, everyone. This is Julie DiLeonardo with Liberty One Wealth Advisors, here to share some valuable insights on your portfolio. Today, we're addressing a big question. Do you really need to own international stocks? It's a hot topic, especially with the US stocks performing so well over the last decade. Considering the UK rate cuts today, let's dive into why this matters and how it might impact your portfolio. So let's start with the obvious. US stocks have been the clear winners for the past decade. If you've been investing in the S&P 500, you've likely seen some impressive returns. In fact, US markets have outperformed international stocks significantly since 2010. But here's the thing, this hasn't always been the case. From 2000 to 2010, international stocks actually outperformed the US. This highlights an important point. Market leadership is cyclical. Just because US stocks have been dominant recently doesn't mean they always will be. And if you are taking that risk, it can be very costly in the long term. This brings us to diversification. The whole point of diversification is to spread your risk across different investments so that no single market or asset class dictates your entire portfolio's performance. International stocks play a key role here. Why? Because their economies, industries, and even market cycles often differ from those in the US. For example, emerging markets have unique growth opportunities that you just won't find in US companies. And while these markets can often be more volatile, they offer potential for higher returns over the long term. Now, some investors argue, do I really need international stocks? After all, large companies like Apple or Microsoft already generate a big chunk of their revenue overseas. It's true, companies in the S&P 500 have global exposure, but that's not the same as owning international stocks directly. For example, if you avoid international stocks, you miss out on exposure to industries and companies that are more prominent overseas, like certain energy or consumer goods sectors in Europe or manufacturing hubs in Asia. Additionally, international markets don't always move in sync with the US. This lack of correlation can provide a hedge, potentially reducing overall portfolio volatility when US markets experience downturns. Another point to consider is emerging markets. These are economies like China, India, or Brazil that are growing rapidly but are still developing. While these markets are riskier, they also offer unique opportunities for growth that you won't find in more mature economies like the US or Europe. So while emerging markets might only make up a small portion of your portfolio, they can add a layer of diversification and potential upside for long-term investors. So do you need international stocks in your portfolio? The answer depends on your goals, time horizon, and risk tolerance. But for most investors, the answer is yes. They're a critical piece of a well-diversified portfolio. And remember, investing isn't about chasing what's hot right now. It's about preparing for the future, both seen and unforeseen. International stocks can help protect your portfolio against these market shifts while offering opportunities for growth. If you're not sure how international stocks fit in your strategy, speak to a certified financial planner. At Liberty One Wealth Advisors, we're here to help you make smart decisions about your investments.